Hello everyone, my name is Gabriel Stein and I would like to welcome everyone to our third Oxford Economics podcast. I am sitting with my colleague Alessandro Theiss. Alessandro is one of our economists who covers the Chinese economy, and we're going to talk about monetary policy, fiscal policy and the Chinese housing market. Let us start with the housing market, Alessandro. It's been going up and down. It's been a bubble. The authorities are stimulating, no tightening, no stimulating again. What is currently going on in the Chinese housing market?
Yeah, it is quite a wild market, as you mentioned. We have seen significant excesses building up since 2009 in the real estate sector. This is has been a response to the global financial crisis by the Chinese authorities, as they have seen external demand collapse. But on the other hand, in our view, it's also an issue of overly positive expectations about housing demand from developers.
You mean, so what you're saying is, on the one hand, the authorities stimulated the market, but on the other hand, there was also very high expectations.
Exactly.
But we've seen house prices rose quite substantially for quite some time, didn't they?
Yeah. That's also a function of having a lot of private savings in the economy, and at the same time a closed capital account. So the housing sector is also a source of investment for a lot of households in China, and not only for pure housing demand.
Better than the stock market.
Yeah, this is where the money has shifted to now.
So right now you're saying there is substantial excess capacity in the housing market, and how are we seeing this? What makes you say that?
So there are two key ratios that we look at quite closely to assess the scale of these imbalances. The one is the ratio of property under construction to sales. On this metric, we estimate that it would take around 5 years now to sell the current housing under construction at the current pace of sales. And
let me just mention something there. That could perhaps be compared with the inventory of unsold new homes in the United States, which tends to be around anywhere between, say, 3 and 7 months worth. So you're saying there's an inventory of unsold homes and of homes on construction in China that would imply 5-year inventory.
There are considerable issues, obviously, with the data, like always in China, but there are comparable metrics. Not all of this housing has been completed yet, so these also includes housing that may have been started, being on hold at the moment, but it's sizable. And what is also astonishing is the ratio is now twice as high as its average between 2006 2010. So subsequently to the global financial crisis, we really see a pickup there of construction, while sales have not followed suit. This is also true in terms of investment in the sector. The ratio of investment in real estate sector to sales investment has consistently exceeded sales revenue since 2011, and investment in the sector is now around 30% higher. This is again close to the peak before the global financial crisis, and it shows you that developers are really investing in a market where they're not getting a lot of money out. So this also tells you a lot about the health of real estate developers' balance sheets.
Excess investment, massive supply of unsold homes, prices falling?
Prices are falling, have been falling for 11 months now.
How much?
We estimate that they're now around 6% below peak. The falls have moderated a bit because the authorities have stimulated the market quite a lot. We have seen reductions in transaction costs. We have seen lower loan down payment ratios. Because in China there's still quite high down payment ratios for private buyers in the market, around 40%, 30-40%.
Okay, so the price is falling, presumably, and the authorities stepping in. So they lowered the down payment. Is that another way of saying they've upped the loan-to-value ratio?
Basically, yes.
Yeah.
Yes.
But we also know that one of the things in China, we know that the authority of the Communist Party really rests on being able to provide stability in the first place, but economic growth in the second place. And what you're saying here is that prices are tumbling. That must be bad news. People don't like that. What else are the authorities? Are they trying to stimulate the market in other forms, in other ways right now? And in what other ways in that case, in addition to what you just said?
So what you mentioned is really key. So the problem with the real estate, the deceleration, the correction in the real estate sector is that the real estate sector directly accounts for 15% of GDP, and nearly twice as much if we take all the sectors serving real estate into account. So we have already seen quite a sharp decelerations in those sectors directly affected by the real estate sector. For example, steel production, cement, glass. But we think that this year the deceleration, the correction in the housing market will feed through the wider economy, and this obviously creates some problems for these authorities for social stability, because if employment is hit, as you say, people will not be happy, and that could undermine the power of the Communist Party.
Or presumably people are simply unhappy if the prices of their houses are falling as well.
That as well, yes. But they have found, as you mentioned, the stock market, which has more than doubled since the middle of last year.
And that brings me to the second point that I want us to talk a little bit about. We've seen already the Chinese authorities easing monetary policy quite substantially. There's been cuts in the reserve requirement ratio, there have been cuts in interest rates. I know that we think they're going to expand the band in which the RMB is allowed to fluctuate and so on. But on the other hand, is the stock market a bubble? Debate and discuss. What is the authorities' policy stance right now, both monetary and fiscal? And is there, perhaps I should ask, is there actually a coherent policy stance as far as we can judge?
That is a very good comment. So we see a lot of stimulus happening, a lot of actions from the PBOC in particular. And as you say, they're fighting on many different fronts, and this makes their task so hard at the moment, so difficult. In addition, so with the confidence in the economy lower now, we're seeing record high capital outflows. In a response to that, the PBOC has cut the reserve requirement ratio. But money growth has slowed substantially in March, so below 10%. So what we think about, we think that monetary conditions have not really eased a lot, despite the easing we have seen so far by the PBOC. This is because the real effective exchange rate continues to appreciate sharply because of the strength of the US dollar. So the stance of the PBOC at the moment is more accommodative rather than expansionary. So they will have to cut the lending rate more, will have to cut reserve requirement ratio more to offset these capital outflows. But overall, they're not really stimulating the economy a lot.
You're saying they will have to. That is, say we expect them to.
Yes.
No, that's absolutely fine. But doesn't this also risk inflating the stock market further?
That's exactly the balancing act, just inflating the stock market, and at the same time possibly reinflating the credit boom that we saw after the global financial crisis. So that's another key issue that the authorities are concerned about, because overall debt in the economy has increased substantially over the past years, and they want the private sectors, especially companies and developers, to deleverage rather than to take on much more debt, because that would shift the problem further down the road, but not solve it.
Okay, so what we're seeing here, we have an economy where the authorities possibly are trying to stimulate, but not too much, where there is excess debt, but there's a weak housing market. All of this sounds to me as if we are saying that the outlook for Chinese growth is really not that great. So the authorities are saying growth of around 7% this year. What do you think?
Our baseline at the moment is 6.6%. So that would imply that the authorities missed their growth target again. But we have to differentiate, I think, in China between, on the one hand, housing sector and heavy industry, which are the sectors suffering the most at the moment and dragging down parts of the economy. But we have other sectors that are not so affected by the slowdown so far. So, for example, services, consumer spending appears to be keeping up quite healthily. I mean, slowing, but not as sharply as what we're seeing in heavy industry. At the same time, there's the government will try this year to stabilize demands by higher fiscal expenditure. So the central government has already announced a wider budget deficit for this year, and by having strong infrastructure spending. And local governments appear to help local businesses via tax cuts or subsidies to maintain employment. The question is how effective these measures are.
And on that score, perhaps the last point, you did mention local government, but isn't one of the problems in China the heavy indebtedness of local government and the indirect way in which that has been done using local government financing vehicles and so on?
Yes, exactly.
So we risk adding to the debt of the local government sector. Exactly.
This is also one key risk for which also we downgraded recently the forecast for this year, because on the one hand the central government wants to rein in this off-balance sheet debt accumulation by local governments. On the other hand, they need local governments to increase their spending, but local governments have only highly limited access to capital markets. So the central government could really risk to push local governments to cut back their spending to run down this debt, while at the same time not implementing the stimulus that the central government wants to see.
Well, it sounds very interesting. There is a British saying that there is an old Chinese curse saying, "May you live in interesting times." That's actually not true. There is no such old Chinese curse, but it certainly does look as if the Chinese economy remains, of course, crucial and interesting over the next year or so. Thank you very much, Alessandro, and we will be back next week for another podcast. Thank you, everyone, for listening.
Thank you.